and YouTube blog covering the German startup scene with news, interviews, and live events.
Hello and welcome, everybody. This is Joe from Startuprad.io, your startup podcast and YouTube blog from Germany, as well as the world's first internet radio station dedicated to startups and tech companies called Startup.radio. Today, I have Stefan here with me, who is the founding partner of AlphaQ, and that is a little bit uncommon investor because those guys are looking to raise a 1 billion fund of venture capital funds that will be established as an evergreen entity. A lot of geeky fintech talk. Don't worry, we'll get through it. First, I would like to welcome you. Hey, Stefan, how you doing?
Hi, Joe. Thanks for having me. Super excited to be here. Having a podcast and radio show is something very cool. Very excited about it.
Yeah, totally. And your interview will, of course, go into our internet radio station in the Investors Corner. So don't worry, it will be on air for years. But at this time, and I would like to welcome Startupraven.com, the easiest and most efficient way for startups, investors, and corporation partners to connect and to find each other. Go down here in the show notes and register for early access. That said, I have been looking through your LinkedIn profile, and of course, it will be linked in the show notes. And I've seen that you got around quite a bit with studying, right?
Well, yes, that's how I started. I was born in Munich, but then moved to the UK when I was 15 to boarding school. So I kind of left my parents' house very, very early. Finished school in the UK, and then started my bachelor in Vienna, studying communication science and business, and then later did my master at a French university called ESCP, where I spent 1 year in London, half a year in Paris, and half a year in Berlin.
For everybody who doesn't know Vienna, it's totally worth a visit, especially before Christmas, right?
Absolutely. Vienna is a great city also to study. Compared to Munich, especially, the real estate prices are still relatively fair, so you get very nice flats, which is a very important point for students.
Yes, totally. Plus, I would add, if you plan on doing vacation there, try to avoid the very hot month, July and August, when you can't deal with heat. But it's much, much better than, for example, Rome. But nonetheless, it can get very hot there. Personal recommendation, fall, spring, or shortly before Christmas. Now that we made a non-paid advertisement for the city of Vienna, let's talk a little bit about what you did. The first noteworthy stop I have is you've been actually working for Groupon.
Yes, so I started my career after my university in management consulting, worked for Roland Berger and a private equity fund later, and then was recruited by Rocket Internet in 2011. And through Rocket, I joined Groupon in the crazy days, and moved to London, experienced the whole daily deal growth that is very similar, I think, to how it must feel to work at Gorillas or any of the quick commerce startups, because we were scaling like crazy. We opened up 42 countries in 9 months, grew to 14,000 employees in that same period of time. I spent 4 years there in total, had to scale it down, unfortunately. So this whole roller coaster was very, very, very deep for me to experience. And yeah, that's how my career started. And that's how I started in venture.
And I see that you founded 2 companies, at least one of them may be vaguely familiar for people who've been listening to our startup news for quite some time, because you founded Watchmaster.com and later FinCompare. I'm a fan of the good old stuff. So can you talk just a tiny bit about what Watchmaster did and what you did there?
Sure. So in 2015, I left Groupon. I moved to Berlin to start my first startup, Watchmaster. I did it together with some former colleagues from Groupon. And the whole idea was that watches are a really high price item, but they don't really have a great secondary market, right? So it's almost as expensive as a car sometimes, and it's really hard to sell, right? So it's very easy to buy and sell used cars, but it's actually back then, especially, it was really hard to buy and sell used watches. When you went to like a physical store, you always felt a little bit ripped off. The people there aren't really trustworthy necessarily. And online, to sell your own watch on eBay is also kind of risky. Yeah? Then you're online with your full address, with your name, and then there may be a watch for 10,000 euros or more, and suddenly people may stand in front of your house, and they may not be so friendly. And so the same is true, however, for the buyer of a watch over eBay. They don't know if it's authentic. And so we thought with Watchmaster, we can solve this problem by building a vertically integrated marketplace that allows buyers and sellers of watches to have a trusted third party in the middle. So Watchmaster is buying the watches and getting watches from private individuals. They do refurbishment authentication in-house, and then they sell the watches on with an additional guarantee, therefore providing trust to the buyer that the watch is authentic, that it works, etc., and trust to the seller that he will actually get his money at the end of the day. And so this business is still around. I did a secondary. I'm still a shareholder there. Watchmaster did actually very well during COVID, as you can imagine. So it has grown significantly. I don't know exactly where they are in revenue, but probably close to 100 million by now. Yeah, so it's been growing very, very fast, doing very well. And in the early days, when I was still running it, we had the problem that we were buying the watches on our own balance sheet. So it was really working capital intensive. By now, it's more a commission model. And this working capital, we were always comparing different financing offers from banks. Yeah. And as you can imagine, working with banks and being back then still a very small business. Yeah. We were doing maybe 2-3 million a month in revenue. So the banks always looked down to us. And so it was really like never really a yes or a no. It was always like a maybe. So you kind of had to send more and more documents. You had to go to physical meetings with them. So it was really a strange process, I thought. And so I thought, hey, why is there not a Check 24 for SME financing? And that was the idea for FinCompare for my second startup. So then I left Watchmaster and started FinCompare, really with that thought in mind, to help SMEs find, compare, and close the best financing solutions. Yeah. And so FinCompare has over 200 bank partners. Many thousands of SMEs were financed through it, and we sold the business last year to the Volksbanken Group. Unfortunately, FinCompare didn't fare so well during COVID. COVID wasn't that great for financing businesses, at least for us, because we were heavily depending on traditional banks financing our clients. And in the beginning of COVID, most lending was stopped, and also a lot of public money was, as subsidies, was fueled into the market at very low interest rates. So that wasn't that great for us, but we built a big software platform over the years that was really relevant to a lot of brokers and financing advisors in banks. So that's why the Volksbanken Group, one of Germany's largest banking groups, saw a big asset in the platform and in the business that we've built. And so we managed to kind of find a new home for the company, for the employees, and especially for the customers to continue that journey as well. And for me, this meant I didn't want to be part of that sort of asset being sold. For me, my career, I think, shouldn't end in a bank. So I left Watchmaster operationally about a year and a half ago. I joined Intel. I had a job offer from Intel to run their early stage startup activities across Europe, build up an accelerator for them called Intel Ignite, focusing on deep tech startups, pre-Series A. That has been very well received in the market. We've done 2 batches of 20 startups with really, really great feedback. And in parallel, I was working already on AlphaQ. And as you can imagine, building such a large vision and building a fund of fund out of nothing is a big risk and big journey. So obviously, at some point, I had to leave Intel, and that point happened at the end of February. And now I'm full time working with my partners on AlphaQ. We've launched a fund. We've done our first investments, and the cat is out of the hat now.
Really, really cool. I have a few pieces of information, but I did not want to interrupt you. You've been really on a roll there. First, you've been talking about the price of a car. I actually saw a wristwatch of Klaas Hutter, which almost retailed for the price of a house, so very expensive there. And I have to admit, the people who are working with those wristwatches every day, their patience is incredible, taking them apart, but especially I admire that they can fit them together again at the end. And it's the best skill ever.
It's very interesting what you say, right? Because if you're building tech startups, usually the most, let's say, the most interesting people you need to manage are usually developers. Yeah, so they're also special. And if you have to build a watch business, at some point we had 14 watchmakers working at Watchmaster, and they were all in Berlin. And these watchmakers, they sit in front of these tiny, tiny devices the whole day, tinkering in there, putting them together, taking them apart, not losing a single piece, luckily. But it's a crazy job. Yeah, I mean, it's a very different skill set to what I can do, but the people that do it are fascinating. Yeah, so it's a very cool job, and super interesting also to learn about the details and the functions of a watch.
I actually, when you've been talking about this, yes, that's totally different. But I had one question. I would imagine the people who are sitting there, it's very quiet, and you can hear the drop of a needle in those rooms.
Absolutely, it is relatively quiet, but some of the machines, they make noises. So it's a factory workflow. Think of it that way more. It's really. There's stuff going on, right? These machines, there's like cleaning machines, there's little tools, and a lot of them also make noises. So it's not fully quiet.
And when you talked about FinCompare, I remember that you talked about Check24, which is like the number one comparison website to compare everything from credit, as you said, especially for only for retail, to insurances, to cell phone plans, even credit cards and everything. So that was the reference there. And you talked about Volksbanken, Raiffeisenbanken. Basically, they are at one point, I'm sure there was more than 1,000 of them. They're the very small town local banks, helping to fund, finance, keep current accounts and all of that stuff. But together as a group, they're really, really big. So that's what I want to get out of the way. And now we can talk about AlphaQ, like 13 minutes into our recording. But that's a new record. And as I said, you were on a roll. I didn't want to interrupt you there. Let us take a few steps back and try to dumb it down as easy as we can. I would first say usually the construction is there's one person. He gets a lot of limited partners, meaning the people who give him or her money. Then she invests also in this fund, and this is a VC fund that then, in the simplest way, invests in startups. And those people who give the money, the limited partners, they can be like insurance companies, pension funds, and stuff like this. But it can also be other funds who do nothing else than invest into those funds. And that's what you guys are doing, right? It's sometimes called an umbrella fund.
Yes, that's correct. So we are from if you look at the value or the value chain or the chain of money in venture, you have the startups, obviously. They usually the first money they take is from angel investors and individuals, and then later they're raising usually from a VC fund, a venture capital fund. And these venture capital funds, they all also have investors on top of them. Yeah, and this, as you mentioned, can be large institutional investors like insurances, endowments, etc. In Europe, this is very often the European Investment Fund, so it's half government money that goes into a lot of these funds, but it's also fund of fund, again, that invests into some of these funds. Most of the fund of funds in Europe are relatively small. Yeah, so the European Investment Fund could technically be considered a very large fund of fund, but it's a public-private construct. Therefore, it has a certain government near strategy. And in the independent world, there are very few fund of funds that only focus on venture capital in Europe. So there is a certain market niche. However, when we started with this, it wasn't really that we said, okay, look, there's the value chain of VC and where's the problem. It was more from a personal experience. So as I explained you, with FinCompare, I started it from my personal experience as an SME because I found it really hard to compare financing solutions. Watchmaster, I actually also found it because I found it hard to sell my watch or to trade my watch. AlphaQ was also started because over time, me and my partners, we've built up an angel portfolio, of 20 plus investments, each of us. And these startups, they take time and they take a lot of work. Yeah. So you have some winners in there. You also have a graveyard. And then you have a lot of startups that are just still doing the job, still doing the work, but they just take a lot of time. And you have to do your annual reports. You still need to run to the notary, need to read a lot of contracts. And that's kind of a lot of work for almost, I thought always as a hobby. Yeah. And so I thought, hey, this is not really a scalable way to invest money over a very long period of time. You need to professionalize this. And I didn't want to build a VC fund. So I thought, hey, why is there not an ETF on top of venture capital? That was really the core idea where we said, hey, it would be nice to have just like an ETF structure, something like this, which I can buy over Trade Republic or my Comdirect account and or my broker. And I can, through that, participate in the value creation that is actually happening in tech and startups in the early stage and growth stage. So before a company is actually publicly listed. Yeah. And no vehicle existed. And so that's really how we started. And so we learned more and more about the ecosystem, about the LP world, the fund of fund world. I have actually worked at a hedge fund of fund 15 years ago in Hong Kong and did an internship there. So I knew a little bit about the concept, but so that's how the whole journey started pretty much.
I actually like your headline on the website, Global VC Superstars in a Single Stock. So that means you're not only a construct like a fund of fund, or umbrella fund, but you're also an investment company. That means theoretically an investment stock company. Theoretically, you guys could be listed on a stock exchange and people can trade in and trade out of
Absolutely.
This company like any other stock, but the underlying value is actually in those VC funds. And I would be wondering, who are the people who invest money in this? Because I can see from your website that you also enable people who already invested in venture capital funds basically to swap, to exchange their holdings into stock of your company. So that would be, I would say, more or less a non-cash version. Basically, you get assets and you generate stock for this. But who are the people who invest cash in such an undertaking? I would assume everybody who has a big portfolio or want to diversify their risk without skipping private markets.
Yes. So I think, until we can list, this will take some time. Yeah. And I think this is totally fine to build up the portfolio and to raise funds privately and then listing the whole structure once it actually has already done a large investment and has already started to produce returns is a much more stable approach to list a structure like this versus listing a black box. Yeah. And I think right now, we obviously talk to semi and professional investors. There's a lot of demand to actually invest in venture capital, and we have learned that our structure is really suitable to, let's say, at least right now, heavily suitable to two kinds of the range of investors. Yeah, we see that investors that can invest below 5 million. Yeah, so they can't really invest single ticket 5 million plus. For them, it's really interesting. We can take 200K as minimum ticket. So most of our investors right now have done 200K to 2 million in tickets. And these ticket sizes are usually too small to invest into venture capital funds, because most VC funds, they have a minimum ticket of 5 million. So if a smaller investor would want to invest into these venture capital funds, they would have to go through a feeder fund structure, which individually costs money on top, but it does not offer the benefit of a fund of fund, like diversification, etc. It's still only one single fund, and you have to pay an additional fee. There are some platforms out there that offer this, but it's just an additional layer of fee for still an individual fund. And so for us, there's no additional layer of fee. And since we are a stock corporation, to hand out shares and to do the shareholder management is actually relatively easy. And therefore, we can take smaller investors below 5 million. And that's obviously a very big market that is very interested to invest with us. There's a lot of people from the venture capital ecosystem overall who invested, like venture capital fund partners who have an over allocation into their own funds. They don't have so much liquidity yet to invest into many, many funds. And so we are a nice way for them to still participate in the overall ecosystem with relatively smaller tickets. And I think over time, we are now already in the first, we have finished the fund structuring in December last year. And now we've been sort of starting fundraising and launched the fund only last month. So it's very fresh, everything. We are seeing that more and more larger tickets are also very interested. So since we have a fund size of $1 billion plus, so there's actually no limit, no cap on the fund, means that a lot of investors that want to invest a minimum of 50 million or even 100 million in tickets, they are very interested to invest through us because they have certain covenants where they are not allowed to hold more than 10% of a fund. So if they invest 100 million, they can't hold more than 10% of a fund. There's, and at least we don't know, any early stage or growth stage VC fund in Europe that would allow for this kind of structure. There are some in the US, but in our point of view, if you are an 8 billion VC fund in exclamation marks, then you're not that exciting. We really focus on early stage and early growth because we believe that that's where most of the value creation is actually happening. And that's where most of the fund of fund work should also be happening because it's the most fragmented market with the highest complexity. And so we do see that there's a lot of these very large asset allocators now interested in us, and we're talking to a lot of them to allocate, 50 million, 100 million, 200 million tickets. And so this is really the two ends, let's say, of the spectrum where you have 5 million and below, and then 50 million and above, where you have a lot of LPs who are just currently looking to allocate more and more to venture. Because over the last years, venture capital has actually outperformed most other asset classes. We've seen now a correction in valuations in the market, but also in the public markets. So there's not so many assets out there where asset allocators can allocate to. And so they're driven more and more into the alternatives and into the private markets, where venture capital is just now as an asset class slowly starting to mature and becoming big enough and relevant enough to these large asset allocators. Before it was almost a cottage industry, which was very small and nascent. And now last year it was a 600 billion global VC market that will grow to $1 trillion. So it starts to become meaningful to these insurances and endowments. And that's the opportunity we are tapping into.
You already said your target size, assets under management, is €1 billion, which is roughly 1.1 billion US dollars. You've been talking about ticket sizes of 100 to 200 millions. Are you guys actually going above this 1 billion?
Yes. So the billion is only let's say the size for the potential listing. So if you think of it that way, the whole corporate structure is built like this so that we can list it. And the earliest listing window is 2026 because we need 3 full years financial statements if we're not taking any shortcuts. And we don't want to, because also there's these 4 years, they give us enough time to actually raise the billion and invest it also, right? You also need to manage the investing, and you don't want to have too much dry powder lying around and want to be very capital efficient. And we believe that this is a realistic time frame. If it takes a little bit longer, it will take a little bit longer. That does not make any difference to the fund and the underlying economics. but it's a prerequisite for listing. Yeah. So for us, in order to list it in the retail market, it needs to be of a meaningful size in order to get into certain market segments, but also in order to provide enough liquidity for investors to also offload, 20 million tranche without the stock price being influenced too heavily. Yeah, and I think this is really important in order to really make this a success, not to rush it and take it really step by step. And so that's why this billion is sort of the threshold in order to even pursue a listing. But then through the evergreen structure, our gains are actually recycled. So they're reinvested, creating a compounding effect over time. Yeah. And this compounding effect is actually very, very meaningful for us, because if you think of it that way, our target IRR in our sort of portfolio right now is actually above that. You have a 25-30% IRR that will become a realized IRR at some point. Yeah, right now it's only paper money, but after year 5, latest year 7, this IRR will become an annualized return, an annualized cash flow. So if you just stay at that billion hypothetically, you're producing 300 million the first sort of in 5 years time as returns. They get reinvested. You have 1.3 billion. Yeah. And then again, the next year you have 30% returns. And this will obviously increase our asset size. And at some point we will pay dividends. So this is a way for our investors to make actually returns. It's not just to hold the stock and have a very nice green chart in their brokerage account. But actually by getting paid back dividends. Yeah. So this is really, really important to bridge that gap from public to private asset classes.
Mm-hmm. And you've been stating that you need to invest in 50 to 60 funds, venture capital funds. We already know that you're targeting early stage, I would say seed, between, let's say, Series B, Series C.
Yeah, we go up to sometimes D, E. Yeah, it depends on the countries, I would say, right? I don't think there's like, these definitions are very fluffy in some cases. Yeah, I think what we look at is anything just below the private equity threshold. Yeah, so as soon as venture capital starts to mingle with the private equity fund structure, so where you see the companies not growing that fast anymore, becoming profitable, where sort of LBO structures are sometimes used, or debt is used as a way to acquire some stakes of these companies, that's where we don't want to invest. Yeah, we really want to invest into these growth companies, into these growth phases, where in the beginning you obviously have certain execution and technology risks, and then later you have more market risk about sales, go-to-market strategies, and growth. That's where we as founders feel very comfortable to invest, because we know these journeys very well, because we have built startups in these spaces. Yeah, and I think that's also very important, that we understand the funds, we understand the startups, we understand how these journeys really go from and how hard it can be, and that also makes us a value at LP to the funds that want us to partner with them.
Mm-hmm. According to your website, you already have 50 funds secured. Can you tell a few names of asset managers, VCs you already invested in?
Sure. I mean, we have done our first investment in White Star Capital. It's a US-based fund that is moving more and more also to Europe. They are planning to open up a Berlin office. We are actually the first German LP that they've accepted. They were a highly oversubscribed fund. I would say more on the established side. Yeah, in our investment strategy, we follow a barbell model, where on one hand we have established tier 1 funds who have at least 3 fund generations of proven top quartile track record, and on the other hand of the barbell we have emerging breakout VCs, which are usually first time or second time fund managers, but not first time investors, who are just getting started with a new concept, with a new fund, usually in a specific technology sector, so focusing on fintech, Web3, or sort of certain emerging technologies. But it can also be larger setups like 468 Capital or something like this in Germany, which is more a generalist fund, but of a very experienced team that has built multiple successful funds before. The second fund we've done is called Nucleus Capital. It's a micro VC on the emerging manager side, focused on food tech, synthetic biology. So the GP has been a very successful investor at Atlantic Food Labs, and then decided to kind of spin out and start his own fund. That's a very common story, that you have these principals who don't get partner, who don't have enough carry, etc. But they actually do all the work. They get the deal flow. They kind of know their way around. And so they at some point decide to start their own fund. We see this all over Europe. And actually over the last 5 years, we had over 3,500 new funds created across Europe, in this emerging manager bracket. And so this market is extremely fragmented, but this market is where the outliers are created. This is where you can have a 100x return fund, because these funds are sometimes only 10 million large. And that's where these large asset allocators who invest into us, the 100 million single ticket investor, has a problem because he can't allocate to the 10 million fund, because it's just far too small and it's far too much work to scout them, to look at all of them. And so that's where we come in as a fund of fund to bridge that gap.
I've read in your materials that you will have approximately 1,200 startups in your portfolio. Is that about right?
Yes. Yeah, it's about right. Also, I mean, the fund size of we say between 40 and 50 funds. Yeah. I mean, in terms of assets, in terms of monetary assets, we are allocating 50-50 between emerging and established funds. But for the established funds, the ticket sizes are usually larger. We do invest from 1 million to 20 million. So this is like the range. We never do more than 10% of a fund. And so we will have over time probably more in terms of volume on the emerging manager side, because just the ticket sizes are so much smaller. But we believe that venture, like small, is beautiful. So funds have to stay small to a certain extent. We don't believe that, a seed fund of more than 400 million, which is sort of the largest funds we see in seed currently, that they will be hugely successful. Some of them maybe. Venture is always, they can also be good outliers in there. But I think the bigger the funds get, the more difficult it actually will be to hire more partners, to grow the team, right? And to spend the same amount of time with the startups, and especially in early stage, this is required to work with the founders and not just be money, to help the founders take the right decisions, to sit on the board, to help them on their journey. And so we believe that most of these funds should remain relatively small. So we don't invest in funds that are bigger than 1 billion, as an example. Most of the micro VCs are below 100 million, and some are like 10 million. So very, very small. And I think for us to have a very concentrated portfolio is really, really crucial. We don't want to build an index, because VC still operates based on a power law. So the top 1-2% of the portfolio will be the heavy outliers, right? And this is really important. If you have one single fund, a normal VC fund invests in between 15 and 25 startups, and usually there's 2-3 really great outliers in this portfolio, and the rest you can write off. The good fund managers still find exits for the other startups, but the really great returners that give you the 5-6x on your money, these are only a very small percentage of this whole portfolio. And so if you have 40 to 60 funds, you're still very concentrated in venture, in the early stage and growth stage category. But your likelihood to hit these outlying startups obviously increases significantly with the portfolio size. And so over that portfolio, we have exposure to around 1,200 to 2,000 startups, depends a little bit over time. But that is obviously hugely important for risk diversification. And for some investors, it's really important for deal flow, etc., for later co-investments and direct investments, if they want to double down on the winners of this portfolio and invest later in really late stage round or pre-IPO.
I understand, but I'm afraid many people who are not into investing or venture capital are already turned off by now. I would just like to add that apparently you have very good supporters also on your website, including Florian Heinemann, the founder of Project A, or also Maximilian Teintal, the co-founder of N26. So it looks like there is more good news to come. Everybody who'd like to learn more, they can go down here in the show notes. There will be a link to your company website. Are you currently having any restrictions on which investors you can take, since they're all professionals, or most of them are professional investors, I would assume?
That's correct. So we can take all professional investors. We do have investors mostly from Europe, but we do already have US investors. We have a really strong international network where we get more and more investors interested. And so, there's no geographic restrictions. Since it's a German stock corporation, the taxation is also very straightforward. There's only capital gains tax in wherever the investor is based. So there's no taxation in Germany. And this is also hugely important from a corporate structure for a lot of these institutional and professional investors.
Great. So only thing left for me is looking forward to speak with you a few years down the road. Best would be before the IPO.
Would love to. Thanks so much.
It was a pleasure talking to you.
Bye-bye.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.